one of the biggest misconceptions that I've seen that investors have as it pertains to maybe quote performance in private equity is they think distributions equals performance or results. And that is absolutely not the case. It couldn't be further from the case. Oftentimes the goal is a controlled exit, okay, not a monthly dividend product. Okay, the goal is how much are we going to grow this investment so that we, number one, have a tax advantage, and number two, maximize our overall investment along the way. If you only judge a private investment by cash flow today, then you're going to miss the overall wealth creation. And that's where the extremely wealthy have built their wealth in private investments. It's in the exit multiple. How many times over can you turn your money in the shortest factor possible? And so cash flow, yes, cash flow plays a little bit in that equation, but it's not the focus of that equation. And if you're looking at those four keys that I was talking about, that I talk about all the time, equity or buying at a discount, appreciation, what's your factored growth, and what can you expect based on history for your investment to grow by, and that's focusing on micro and macroeconomics perspective as well as operations, and then cash flow and tax advantages. Well, cash flow is going to fall into the last one, the least most important. We want cash flow on most of ours, but there's actually some investments that I've underwritten that are fantastic investments. Some of our top 10 investments that we've had that don't have cash flow along the way. Heck, in some of the best markets, new development. Well, new development never has cash flow. But that can be some of in the right market. New development is not the right market today. We do have one new development project going right now, but we've sat on that dirt for a long period of time. We bought right, and we've been waiting for inflation to come down a little bit to start the materials focus on that. But new development can be a great opportunity, but there's no cash flow there. Now, the great opportunities right now are because we are buying off of a bank tape where a bank is stepping in and either forcing an operator to walk away, or the operator just doesn't have what it takes. And this industry can absolutely eat you up, especially when there's turmoil like what we've seen for the last 3 years, and or operators just don't have the equity. And so with the opportunities we're seeing today, we're going to have massive buy side opportunity in that we're buying at a significant discount. Sure, that'll create cash flow, but overall, make money in your buy and focus on investments that, number one, you've got the equity on the front end and are going to appreciate over time based on your operations management and operational control. And that's where your focus should be, is on, how do you control the asset along the way, and how do you control the exit? So
you talked about new development, and that it doesn't produce, obviously it doesn't produce cash flow, but obviously you sometimes have operators that predominantly only do new development, yet they still claim distributions or promote distributions. Walk us through how a group that only does new development, which obviously is not going to put off any positive cash flow because there's no income, how do they still get around and do distributions?
Well, there's a group right now that's in a class action lawsuit for that. That was a large private equity group, and at the end of the day, yeah, equity growth plus deleveraging is going to be your overall focus, and that's across any investment, and that's going to be more so focused than cash flow. But what ends up happening is when large groups of the market come in to look at something new and they have misconceptions, then you've got the price beaters that go out there and try and beat other operators in the market by being the best offer or best price, if you will. They try to be the Walmart. And that's not ever going to happen because at the end of the day, you've got the BlackRocks and the Blackstones, and those groups have set the standard for cheapest cost of capital, and so what ends up happening is you've got these developers that'll come in and they'll say, yeah, we'll pay cash flow along the way, and what they often do is they sell the investment as a completed project on the front end before it's ever completed. And they bring in the capital and they structure the capital stack based on a completed project. Then, as they bring in the capital, they start to develop the project. And so now they're able to pay out distributions with new capital coming in. Because let's say an operator bought a piece of land for $1 million. They're going to develop a new development for they're going to do the horizontal work. They're going to do all the flat work and everything for another $3 million. So they're all in at $4 million bucks. And then they're going to spend $16 million on the vertical development, and it's going to be a $20 million flat cost. But then once all of the $20 million development is done and they lease up the asset another year later, after the work is done, the value of the asset based on NOI is $28 million. What they do is they end up selling the project for $28 million to investors on the front end before they recognize or before they develop the asset and accomplish the overall value. And that, number one, is just lining the operator's pockets on the front end. There's a lack of alignment there. Number two, they're paying distributions based on capital coming in, not based on recognized growth. And so they run the risk of, first investors in and first investors out get their money back out, but the back end investors don't ever get their capital out because the asset never meets its full potential. So we've seen that. And then Brian, I'm curious, we've talked about REITs before. So REITs have a distribution requirement that's built in and calculated in. And then furthermore, many of these large REITs and or large private real estate investment groups that are some of the largest ones in the country have structured into their bylaws where regardless if the investment fund is operating at a operational loss or operational net positive, they allocate in new capital coming in as a distributable form of income as well. So share with us a little bit about that.
Yeah, that's something that we've seen more and more, where you may have an investor who is invested in a REIT and they, I'm doing air quotes here, show a positive return. But if you get the latest prospectus, they're typically updated on a quarterly basis. Dig into the earnings because it's going to show the underlying investments of that portfolio and the operating income and the ultimate net profit. And interestingly, for one of the larger private equity REITs that are out there in the marketplace, they've had positive returns for the past 5 quarters, but negative operating income for the same past 5 quarters. So then you have to peel the onion a little bit further to look at how are returns actually calculated. And to your point earlier, it can factor in new money coming in. So that actually goes towards the return metric, which you could argue is probably not the most accurate way to factor in a return.